Let's get this thing started. Welcome to the Stock Market Fundamentals course. Today is the beginning of a 4-part class, and these are the dates for our coming classes, coming sessions. And basically, we're going to go over today, what is a stock? December 5th, we're going to go over technical analysis. December 12th, we're doing trading indicators. So basically, different indicators that you can use. One second. Different indicators that you can use to read the charts, right? To read stocks. And then December 19th is going to be a full recap. So y'all going to teach me what y'all learned, right? So yeah, let's get into it then. So a little bit about myself. My name is Winston Robertson. I'm from Houston, Texas. I'm a U.S. Navy veteran, and because of that, I got to travel to multiple countries. I've been all around the world for the most part. I've been to places where people say I love Black people, right? And we don't hear that. We don't hear that too much here. So I've definitely had some experiences that were crazy and sort of like out of body and unexpected. I graduated from National University with associates in general studies. Then I decided, hey, college is great, but having a skill is better. So I decided to develop a few skills. I've been trading stocks since 2017, but I've been trading options since early 2019. My first experience with stocks was Snapchat. When Snapchat first released, it released for like $15. And for the life of me, even now, I wish I would have held those to this day. But learning lesson, you learn as you go on. Disclaimer real quick, I'm not a financial advisor, right? So I cannot tell you where to put your money and when to put your money somewhere, which is why even in my stock group, I will show people how I find plays. I will show people what I'm looking at for specific plays, but I will never tell you, get in right now. I will never tell you that. You have to make those choices based off your own due diligence. If you don't know what due diligence is, you're gonna learn today. So by watching this and reading this course, you understand that there are significant risks in trading on the stock market, and you are the only party that can be held liable for any losses or gains you make in the stock market. So all that means is whether you win or lose, it's on you. I can show you what I learned. I can show you what I'm continuing to learn. I can share everything that I'm looking at and that I think with you, but it's all going to come down to you. How much work are you going to put in to be successful? You know what I mean? So let's keep going. So the stock market is not a get rich quick scheme. Please don't think of it as that. Think of it more as a savings account. This is another savings account with a higher interest rate return. That's how I like to think about the stock market, right? If all you have left is your rent money, don't put it in the stock market trying to double it up, because you can lose that and you're gonna be mad. You're gonna be pissed. If all you have is $2, last $2, one for the jukebox and one for the bus fare, don't put it in the stock market, bro. You ain't gonna be able to catch the bus later, right? And don't expect to get rich overnight, even though it can happen. Even though you have more of a likelihood of getting rich overnight in the stock market than you do putting your money in the bank, my personal opinion. Don't expect to get rich overnight, right? Let's go. So the stock market is a way to grow your assets and change your life, right? And the reason I say that is with the stock market, you have the ability to make money while you sleep. You have the ability to make money while you're at work. You have the ability to make money while you're driving, not on your phone holding it right then and there, but you have that ability, right? You make a trade, you put it down, you drive to your mom's house, you drive to work, you drive to out of town, you check your phone. Oh, I made some money, right? You have the opportunity to make money anytime that this market is open, right? Anytime, every day is a new opportunity to make money in the stock market. That's why I feel like it's a way to change your life, because when you go to work, how much you get paid is dependent usually on how much time you spend at that job, right? Same thing goes for the stock market. You're gonna get what you put out of it, but the difference is you have more control of when you get paid, right? It's not dictated by punching the time clock. It's dictated by watching charts and understanding patterns and understanding what's going on with the world around you. right? So the stock market constantly changes. Like I said, this means there's always a chance to grow, right? So if things this that's kind of the reason why I never get bored with the stock market, right? Because you're always growing and it's always changing. Just as soon as you feel like you got a hold on it, something happens in the world, like Omicron, the new vid out there, right? And it causes an extreme change in the market. Um, for example, like when this new vid came out, right? Stock market tanked. So things that happen in the real world, they affect this market. So the more you have your eye on what's going on out there in the public, right? The better you're going to be in this market, right? The better you're going to be able to react with this market. So a few things, remember these always, no matter where you go, just remember these. Start small, right? Taking small risks to learn how a stock's move. So basically, if you have a $200 account, you're not going to bet the whole $200, especially if you're new to the stock market. I don't want to say bet, excuse me. You want to trade. So if you have a $200 account, trade 10% of that account at a time until you learn how the stock moves, until you learn how the stocks react to news, until you learn how the stocks moves over a period of time, right? And next, researching before investing in funds. That's what we're going to learn here today. We're going to learn a little bit about research. It's always good if you decide you want to invest in something long-term, stocks, to know what's going on with the company, right? Or to know a few details about the company. And we're going to go over some of those today, right? And then you always want to have a personal investment goal. So I'm not just in the market trading every day. If you read my bio on my Instagram, it says I'm making $100 a day. This is passive income for me. Yes, I want to be rich, but I know it's going to take time. But my goal during that time is to at least make $100 a day. As long as I can make $100 a day from each one of my side hustles, I am perfectly fine. And let me tell you, I got a couple side hustles that make me $100 a day every day. So always have a personal goal, right? That's extremely important. And then have patience. You can't rush a trade, right? You can't rush learning. No matter what other people say or what other people are doing or what's going on with other people, like your time is gonna it's gonna happen for you when it's time to, right? You just have to be prepared for that moment. And then secondly, have fun, right? Once you're able to recognize signals, once you're able to recognize patterns, right? This becomes more of a tool and it becomes more exciting as you wake up and pull up these charts. I wake up every day excited because I don't know what this market is going to do, but I know for one thing for sure, I know how to react to news depending on if it's good or bad. I know how to read a pattern. I know how to look at support and resistance to know where the stock could potentially fall or where it could rise, right? And it's exciting for me when things go in my favor or they go the way that I'm looking. And it's even exciting when things go the opposite way because I learned something new. I learned a new tactic, a new strategy, something that I could add to my bag that I know to look for, right? So this shit, I don't mean to curse, but it's always exciting for me. And the funner it is, right? Those losses become lessons when this stuff is fun, right? You're better off when you look at this stuff as lessons and you're having fun, opposed to being disgruntled every time you take a hit or being mad every time things don't go in your favor. You can learn from everything that happens in this market. Everything is a learning experience. So what we're going to discuss today, we're discussing starting from the bottom. So basically what are stocks, where they're traded. We're going to go over common stock terms, and then we're going to go over types of orders, basically ways that you can buy and sell stocks on multiple platforms. But we're going to talk specifically about Robinhood. And then we're going to go over some points in fundamental analysis. There's a bunch of ways to do fundamental analysis, but we're just going to go over some things that I look for. So starting from the bottom, we're gonna go over what is the stock, where stocks traded, the platforms used, what are stock market sectors, and why I trade stocks, right? So stocks are a way to build wealth, right? They represent ownership in publicly and privately traded companies, right? Stocks are referred to as shares. All this means is, what this tells me, when you buy a share of a company, you are an owner. You own a piece of that company, right? That doesn't mean you have say so in what that company does, right? All that means is that company owes you some information every quarter, and that you're an owner. Be proud of yourself, man. You got to clap it up for that, because people don't know that. People don't know that just by buying a share of something, you can become an owner. Like, that's a good feeling. Be proud of that. Be super proud of that, right? That's an amazing feeling. So here's an example. AT&T is traded around $28 to $29 per share. Right now it's around 24. If AT&T had a total of 100 shares and you brought 10 shares, right? You're 10% owner of that company. Never overestimate the power of stocks, right? You can be an owner just by owning shares, right? It's just, kicking a dead horse right now, but I'm trying to drive home a point, right? You can be an owner, and that automatically puts you in a new category, right? You're a different person just because you're an owner now, right? People aren't thinking about being owners right now. Well, the people who stuck doing the same old thing aren't, right? So what is a stock? There are 19 different stocks traded that you can purchase on any brokerage, right? The most common are common stocks, growth stocks, and dividend stocks. And I'm going to explain those three, right? So common stocks represent partial ownership in a company. They are potentially unlimited upside and equal risk. So, I'll say that at the end. Growth stocks are high risk, high reward investments. They represent companies whose sales and profits rise quickly. So think about them as extremely volatile or new companies with high growth potential. They're doing something amazing. So because they're doing something amazing or they're projected to do something amazing, people are constantly in and out of this stock, right? Then you have dividend stocks. Those are stocks that pay shareholders for owning shares. Now, on most platforms, stocks will be labeled by the type that they are, right? So they'll be labeled common stocks, they'll be labeled growth stocks. And dividend stocks, they're not going to be labeled dividend stocks, but if you do research on that company, you'll be able to find out whether or not they have dividends, right? So where are stocks traded? Stocks are traded on stock exchanges. Stock exchanges allow investors to buy and sell shares of a company, right? Examples include the NASDAQ, Tokyo Exchange, the Sydney Exchange, and the New York Exchange. Here in the US, we trade on a New York exchange. So we open up at 8:30 every day and we close. Well, on Robinhood, you can't buy options after 3 o'clock, but the stock market closed at 3:30, between 3:30 and 4. Right. So you're still, after 3 o'clock, you can't trade options, but you can still buy shares. This brings us to, wait, this skipped a lot. Why did it skip so many? John took us to the end of the presentation. That's crazy. All right. So what platforms can be used? Here's there are more than this, but these are the ones that I'm familiar with, right? So Robinhood, I love Robinhood because it's right on my phone. I can use it on the go. It's a user-friendly format, right? Self-explanatory usually on Robinhood, but there are videos everywhere, and I'm always available if you have questions about Robinhood, right? We have E-Trade, and then we have Thinkorswim. I use Thinkorswim now. You can trade on that platform, but I'm still learning the technicals about trading on the platform, but I love it for technical analysis. Basically, I love it for reading the chart. And it's what I use every day to read charts, right? Thinkorswim by TD Ameritrade. So stock market sectors. Wait, before I go there, is everything making sense to everybody? Does everybody understand the things that I'm talking about? Let me know in the chat if you're keeping up. Looking at the market. Robinhood does have a small chart. And if you look at it via your computer, there is a secondary chart you can use, but I prefer not to use Walmart for Robinhood for technical analysis, like pocket options. So pocket options are a lot quicker, right? They're like on a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute time frame of trades. With Robinhood, right, with regular options, these are traded on weekly, monthly time frame. So they have weekly or monthly expirations. Sometimes they go all the way up to yearly expirations. Cool. So there are thousands of stocks traded on the stock market, and each one is placed into specific sectors. There are a total of 11 sectors, right? The reason why you need to know this piece of information is because traders are constantly moving their money, right? So as the market shifts, as traders move their money, right, sectors rotate, meaning people take their money out of one sector, they put it into another sector, right? One week financials could be on the rise, the next week energy could be on the rise, right? If you can identify the sector rotation, right, you can stay ahead of these other traders, potentially finding plays sooner and profiting more, right? The goal is to profit more, right? So these are your sectors, right? If you want to take a screenshot of them, we have the energies, materials, industrials, utilities, healthcare, financials, community services, communication services, real estate, consumer discretionaries, consumer staples, and information technology. Real quick, if you're looking at the financial sectors, give me an idea of some companies, right, that you think would be in the financial sector. Think about financials and then drop it in the chat. Give me an example of what you think would be. Wells, are you talking about Wells Fargo? Okay, yeah, absolutely. Banks are in the financial sector. So Bank of America, Chase, Wells Fargo, you will find those in the financial sector, right? What's even great about these individual stocks, there are ETFs, basically large holdings that will represent each one of those stocks, together as a whole. So for the ETF, electronically traded fund, for the financial sectors is XLF, right? That's the ETF for financial sector. In there, you'll find, in XLF, you'll find things like banks, and you'll also find other stocks in the financial sector, right? Here's another example, right? The energy sector focuses on oil, gas production, and renewable sources. You see companies every day that are in this sector. I guarantee it. You use companies every week that are in this sector. I guarantee it, right? Take a look at the example on the side. You see those companies before. You know these companies. These companies are familiar to you. Berkshire Hathaway, Next Era Energy, Exxon Mobil, the gas station. This is familiar to you. When you drive around and you're shopping at these places and you're utilizing these different businesses, just know there's a chance of these companies being on the stock market, and you spend your money with them. You need to find out how to make money off of them, right? So when you get into the stock market, pay attention to the things around you, right? Pay attention to the companies and businesses that you use, because there's a potential that you can make money off of those companies, right? So here's why I trade stocks. These are the 3 reasons I love trading stocks and stock options. I have financial freedom, meaning I don't have nobody making me get up and go to work every day to make no money. I don't have to say yes sir, no sir to anybody to make money. I don't have to bow down to a customer's will when they dead fucking wrong to make money, right? The occasional instant return. I do day trade. So Monday, Wednesday, and Friday, those are the days I typically day trade, right? So that means I'm in a trade. I buy it now. I plan on selling it within the next hour, meaning I can get my money damn near instantly, right? And then overall, right, the stock market has a 10% historic return. The bank only gives you the 1-3%, 1 to 3% from the bank. So you can put $1,000 in the bank and not even get $1 back. How does that make sense? But they using all your $1,000 for their investments, but they don't want to give you nothing but $1 back after a year. How does that make sense? Stock market gives on average 10% annual. That means you can buy like SPY and expect, right? Not, well, I don't want to say expect. What's a better word? Well, you can expect at least a 10% annual return, right? I really don't want to say expect, but that's the best way I can describe it right now. So here's an example. This is the basic principle of trading stocks, right? It's important to know that you only lose money and gain money once you sell your position. So let's say you buy one stock of Nike for $100 per share. The next day it decreases to $80 a share. You haven't lost any money yet, right? You have not lost any money. You only lose money once you sell that position, right? The next day after, Nike could go up to $150 or $130, right? You only gain that extra $30 once you sell your position. So that means you can buy something right now and it goes down all year, right? And you can, with stocks, you can bounce back the next year. If that company has good earnings, that company has good projection, that company has positive news, positive feedback, the CEO is great, right? They're making money, right? That means a year later, that stock could be on a rebound and you can have your money back and then some, all because you weathered the storm. That's one thing I love about stocks, right? You don't lose until you sell. So that covers the groundworks. What is a stock? I hope y'all are a lot more familiar with what is a stock and the stock market sectors. If you want to do further research on those terms and those things that we went about, just hop on Google and type in the term stock market sectors, ETFs, right? Break things down to a point to where you can understand them and gain more information. That's the best way to get better. Here, we're going to go over common stock terms. Charleston, you here, man? I did this course with Charleston. I think he might have stepped out. But in order to learn this market, to learn this game, right, you need to know some of the lingo. That's why I had to add this to this course, right? I had to add common stock terms. Some of these y'all are going to be familiar with, especially my Forex traders. So due diligence, which is what you're doing right now. What we're doing right now is due diligence, right? It refers to investigating potential trades and includes reviewing price performance, company news, financial records, and more. So basically, all due diligence is you looking up these companies, you looking up information for these companies so you can have a better understanding of what they're doing, what they're trying to do, what they're projected to do, all right? That's all due diligence is. So in trading, you have bulls and you have bears. Bulls basically think that the stock or the stock market is going up. They plan on buying because they think prices are going up. Bears sell, right? They think the stock market is going down, right? They think prices will decrease, right? Those are bears. Like I said, market open refers to the time of day that the market opened on the New York Stock Exchange. Here in Texas, that's 8:30. Market close is at 4 o'clock, for 4 p.m. Time market close, time you can no longer trade stocks on the New York Stock Exchange. Typically, unless you have like Webull and you have the early service, then you can trade at earlier times and later times. But that's later on. So price point refers to the current price the stock is trading at. So I can say right now, the price point for Walmart is, I think, like $120. So the current price of Walmart is $120 per share. Market correction. This is important because we're rumored to be able to be going through a correction very soon, right? Market correction refers to an event where price point of a stock declines 7 to 10%. We haven't had a correction since before March of 2019, right? We haven't had a correction yet because ever since the vid first showed up, we've been straight up in this stock market, right? The stock market has been straight up. So stocks don't just go up. Stocks usually pull back at some point in time. And the difference between a pullback and a correction is the amount. That's it. So a pullback, 1 to 5, 1 to 6, market correction, 7 to 10% decline. And yes, you can make money if stocks goes down. It's called a put. We're gonna go over that over later trainings. Not any of the ones that we have planned in December, but those are gonna be in January's training. The next we have highs and lows. High basically refers to the highest point at which that price reached at a certain time, and low is the lowest point the stock price point reached at a certain time frame. Simple stuff, right? Very simple, very easy to grasp. You just got to have the knowledge and know what people are talking about when they talk about this. Because as you immerse yourself into the stock market game, you join communities, you join pages. People, they're not gonna talk like I'm talking to you right now. They're gonna talk in code. They're gonna talk these words, and it's important to know what they're referring to. Right? Day trade and swing trade. Right? These are we're gonna get more into these, I think, in day 3. Yeah, study 3. But day trade, right? Which I told y'all I do Monday, Wednesday, and Friday, refers to buying and selling the stock within the same day. Swing trade refers to buying and selling the stock over the course of multiple days. So buy today, sell tomorrow. Buy today, sell day after tomorrow. Buy today, sell next week. Buy today, sell next year. Making sense? I do hope so. Long and short, right? This is very similar. Well, actually, it's extremely similar to bulls and bears, right? If somebody says I'm going long on Walmart, that means they're buying shares, they're buying calls because they think price action is going to go up. If somebody says I'm short Target, that means that they're buying puts or they're selling their shares because they think price action is going to go down, price point is going to go down within the near future, right? So long bulls up, short bears down. Bid and ask, you're going to see these a lot as you trade, right? So bid refers to the price buyers are willing to pay for a single stock. So I'm bidding $20 for Sony, right, per share. Ask refers to the price sellers are willing to sell a single stock. So I can bid $20 all I want, but if sellers don't want to sell for less than $22 per share of Sony, then my bid is not going to get filled, right? So bid how much I want to buy, ask how much they want to sell. Usually when you have a bid and the ask that's far apart like that, so buy for 20, sell for 22, usually you pay the mean, the average. So you're going to pay what's in the middle. So basically the average, 21, because it's right in between, right? Next, we have volume and volatility, right? Volume represents the number of shares traded at a specific time. So basically, you like the buying volume of Sony is like 1 million right now. There are 1 million stocks being traded to the buy side, or sale volume is 5 million right now. There are 5 million traders, right, selling whatever stock you're selling at the moment, right? Volatility represents the risk assessment of a stock. So basically with volatility, think about it as how quick, how often is this stock moving up and down, right? So high volatility equals higher risk because that stock is moving up and down at a crazy pace, right? Instead of going slowly up or descending slowly over the period of like 30 minutes, right? This stock is creating new highs and new lows every 5 minutes, right? That's extremely volatile. That means you have to be in and out of those trades or you can lose money. With low volatility, there's lower risk, right? Because it's the exact opposite of what we just said. Stocks are increasing slowly over time, right? Meaning you can be in that trade a lot longer because it's not volatile and all over the place. Next, we have averaging down and clap. So averaging down, right? When a stock decreases in price after investors buy a share, the buyers buy more shares to decrease the average purchase price. So let me break that down for you. Averaging down usually means, let's say you buy a stock right now for $10. You buy it today for $10. You buy 10 shares for $10. Tomorrow, it goes down to $5 per share. So you said, hey, this is cheaper than what I think this stock should be. I want to average down. I want to buy more. I want to buy more because I know the stock is cheaper than what it should be. So you decide to buy 20 shares at $5. Now you have a total of 30 shares. Averaging down, when you average down and you buy more at a cheaper price, all you're basically doing, right, is going to bring down the total cost that you paid, right? So think about it like this. Instead of buying 30 shares for $10, you bought 10 shares for $10, 20 shares for $5. So you averaged down, right? You bought more at a cheaper price, bringing your average price down. With clap, clap refers to, getting beat up, losing your money. Clap, you don't want to get clapped. Nobody wants to clap. Nobody wants to clap, bro. We try to stay away from that. When positions usually don't go in the favor that we're looking as far as options, we exit. We exit to reduce the clappage. So that completes stock terms. I hope you guys are a little versed now, and that you can talk a little bit and understand a little bit about what traders talk about when they speak. Next, we have types of orders. These are 4 ways to buy and sell stocks. These are important, right? Because these can save you money, they can make you money, or they can lose you money depending on what you're doing. So before you start buying and selling stocks, it benefits you to know what types of orders you can execute in the market. Your trading style will benefit or fail depending on when and what type of orders you execute. So these orders can be lifesavers. They have been. They absolutely have been. The first type is a market order. So a market order doesn't guarantee the execution of the order, but it's an order to purchase a stock almost immediately. So what you just saw on the side, right, was me purchasing 1 share of AT&T at the current price of $28.72, right? You see the market price. How much does it cost on the market? $28.72. Estimated cost, $28.72, right? A market order can execute at above or below the current bid or ask. So all that means is you can put in an order to buy AT&T right now at $28.72. But in between that time, if AT&T goes up a few cents or down a few cents, you're going to pay whatever the price was once that order executes. So that's why market orders can be good, but they can be bad in a way. But a market order, remember, a market order is an order to buy right now at whatever price the stock is. So a limit order. A limit is an order to buy or sell a stock at a specific price point. Example, if a buyer wants to purchase Coca-Cola at the price point of $50, but the current price point is $53, right? You can place a limit order that won't execute a buy of that stock until it reaches $50. So a limit order says, let me break that down. A limit order says, hey, I don't want to buy this stock until it reaches this price. Or it says, I don't want to sell this stock until it reaches this price. Meaning you can put in a limit order and forget about your trade. Once it reaches the price you want, it's going to buy or sell. You put that together and decide how that can make you money, but it can make you money. Next, we have a stop loss order, right? And this is an order to sell a stock once it reaches your chosen price point. Basically, let's say you enter a trade for $20, and the stock goes up $30. But you're not ready to sell, but you don't want to lose any money. So you set a stop loss to sell if the stock ever comes back down to, let's say, $25. That means you bought at 20, it went up to 30, you held, you set a stop loss to sell at 25. If that stock price comes back down to 25, your loss order triggers, and boom, you're out of that trade still with some profit. On another end, you could buy something at $20, right? It goes up to 25 and then it falls. You can set a stop loss order for, let's say, $19. That way it kicks you out if price action falls below to where you bought it. So you won't lose any money, right? And you can move stop loss orders as price moves too. So again, you imagine how that can make you some money. The next and last type of order is the stop limit order. So this kind of combines the stop loss and the limit order, right? So the stop limit order initiates an order to sell your stock once it rises to a chosen price point. You buy $20, you want to sell it $30. Then it executes a limit order once the stock falls to the lowest price you're willing to pay. It went up to $30, you sold. Price came all the way back down to 20, you had a limit order already set and it bought at $20, right? Meaning you didn't have to do nothing but set an order and let price action do whatever it was gonna do, right? Does that make sense to everybody? Let me know in the chat if that makes sense to y'all. Let me know in the chat. Cool. All right, great. All right, so in my opinion, the most important of the four is the stop loss order right now. I love my stop losses because it stops me from losing money. That's the main reason. I can set a stop loss to kick me out of a trade if it falls to a certain point, meaning I can keep some profit or stop from losing profit. Yo, you can't beat that. You can't beat that. All right. So here's an example. Let's say this is price action, right? You're watching price action. The goal is to buy at lows, right? So you bought at this low, let's say it's $40. Price action ranges around, reaches $60, right? This is usually one where you want to sell. You want to sell at the high, right? And let's say you don't sell and price action falls from $60 to $55. You can set a stop loss order to sell this stock once it reaches $55, stopping you from losing money, right? That's the goal. You want to make money, not lose it. And these orders can help you do that, right? So study those, look more into those, and gain a better understanding of those, and you'll be a better trader, right? Next, we're going to go over fundamental analysis, and this is the last part of our training. And I love this part because as you look at these things, right? As we look at these things that you see here, earnings, market cap, CEO, price per earnings, debt to equity, free cash flow, payout ratio, assets versus liabilities, dividend histories, you're going to learn about these companies, meaning you're going to be that more invested into these companies, which is where you need to be if you want to make money trading stocks, right? You need to be invested into what these companies are doing, right? So let's get into it. The fundamental analysis takes data from a company's financial statement and uses it to determine fair value of a stock. So regardless of taking data from a company's financial statement, right, you are going to determine fair value of these stocks because you're going to look at all this financial information and you're going to compare it to other stocks in the same industry, in the same sector. And you're going to compare these numbers, and that's going to give you the determination of which one is better for me to invest in, which one do I agree with, which one do I like more with what they're doing, what they're producing, how much they're giving back, right? All that's going to be your determination, right? And again, also this is called due diligence. As you invest into these companies, you're doing due diligence, right? You're going to get better just for researching, right? Because you're going to know information about these companies that other people don't know. So a company's financial statement holds its balance sheet, its cash flow statement, and the income statement. Now you don't need to know all the stuff on these sheets, but it helps to be familiar with certain things, right? So those I picked about 8 to 10, I think, things on this pieces of information about these financial statement sheets that I find important that I like to look at, right? So again, those are market cap, trailing price per earnings, earnings per share, debt to equity, equity ratio, free cash flow, payout ratio, assets and liabilities, dividend history, and the CEO. And you can find all this information on Yahoo Finance, a free website, right? I'm going to show you where to find this stuff too. So market capitalization, the first thing on there. This calculates the total dollar market value of a company's outstanding shares to show you how big the company is, right? So basically, out of all the shares of that a company has on the stock market, how much are those shares worth, right? Quick note, large cap companies tend to be less volatile and more stable because they've been around longer, right? And small mid cap companies have more volatility. They're newer. So the things that they're working on are newer. So people are exchanging money in stocks more frequently. And the quickest way to find that, right? On Yahoo Finance, you'll pull up Yahoo Finance, right? You'll type in the ticker. So let's say, let's look at Home Depot. We're gonna say Home Depot, right? Type in HD, click search, and you scroll down, you see the current price of HD, 402.70. You see the aftermarket price, 401.70. So that means it's following $1 in after hours right now. And if you scroll down and look to the right, you'll see right here, market cap, 420 billion. That's how much all the shares of HD are worth right now on the stock market. 420 billion. That's a lot of money, bro. So it lets me know HD is worth quite a bit, right? So that's market cap. Yeah, yahoofinance.com.
Yeah, I said, is it live? Is live market?
You said, does it lag?
No, I said, is it a live? It's like it shows the live market, right? As it's going on.
Oh, right. So when the stock market opens up, all this information is going to update. And as things change on the daily, all this stuff updates. Next, we have trailing price per earnings. Where we at? Right. 1 second. All right, so trailing price per earnings accounts for a company's actual earnings over the last 12 months and is used to judge how valuable a company is, right? So to find trailing price per earnings and to explain it a little bit better, you would, again, pull up the ticker, you would scroll to statistics, click statistics, and look at trailing price per earnings, right? So trailing P&E, the current trailing P&E is 27.53. So basically what you would do with the trailing price per earning, you would multiply the trailing price per earnings times whatever number will give you 402.70. So let's pull up the calculator real quick. So 402.70 or divided by 27.53. And this will give you the trailing price per earning. We come up with 1462, right? So that tells me, all this tells me is that Home Depot is trading 14 times more than the trailing price per earnings over the past 12 months, right? And so as you dive more into trailing price per earnings and you look at different companies, you'll get a better gauge of what's a good and what's a bad. Because in my opinion, there is no such thing as a direct number that reflects a good trailing price per earning versus a bad one. All you can do is compare it towards other companies in the similar field to know what's good for you, what's a good determination for you. Do I need a company that's trading 10 to 15 times its average over the 12 years or 12 months, or do I like to invest in a company that's trading 50 to 60, 25 to 35 times the average over the past 12 months, right? Yeah, close that. Right. Next, we have earnings per share, right? This is pretty self-explanatory. Earnings per share measures how much a company has profited per share of its common stock. Earnings are held quarterly or yearly. So how much company has how much money, excuse me, has this company made per share, right? And I talked a little bit about earnings here, right? So earnings are held quarterly or yearly. Basically, for being an owner in that stock, the stock owes you information every quarter or every year, basically explaining to you what they're doing with their money. And this is where you get your earnings per share. Sheesh. So you find earnings per share, right? Yahoo Finance again, and you scroll to the analysis tab. And you see average estimate, right? So that's your earnings per share. And then you have a year ago's earnings per share. Last year, HD during this quarter made $2.65 per share. This year, the average is $3.18 per share. So they made more money per share this year, which is good. So if the company is making more money, that's a good outlook for moving towards the future. Can they continue to make more money, right? These are the things we want to know with these stocks. Are they making money, right? Are they making money with our money, or are they losing money? If they're losing money, we need to put our money somewhere else. If they're continually making money, then we're good, right? We know that we're going to make it. All right. Next, we have debt to equity ratio. Let me close out of a few things real quick. So debt to equity ratio displays how much debt a company has compared to how much equity a company uses to finance their day-to-day operations. So how much debt does this company have and how much money are they using to run this company, right? That's what debt to equity shows us. And you can find that, pull this tab back over. You can find that in the statistic tabs of Yahoo Finance. Scroll all the way down to the bottom and you'll see total debt to equity, 4 million. So compared to how much money this company is using to run itself, right? The total debt is, I think these are millions if I'm not mistaken. 4 million, right? All this information is free. You can find this information, right? How much debt does a company have compared to how much equity the company uses? And you can even find equity in Thinkorswim. Yahoo Finance. I don't know why I got Thinkorswim on the brain. Next, I like to look at free cash flow. Basically, how much free money does this company have in case of emergency, in case things shut down, in case they're not making any money and they have to pay back debts, right? How much free money does this company have? And you can also find this in statistics, right? And you scroll down, you look at leverage free cash flow. This company has $9 billion. We saw how much they were worth on the stock market, right? But not only are they worth that much money on the stock market, they have some money stockpiled. They got 9.99. They almost have $10 billion stockpiled for a rainy day. To me, that's good. And if you look at other companies in the similar industry, you want to see numbers comparable to this. Well, who has more free cash flow? Who can withstand the pandemic if things shut down, right? Key factors. Next, we want to look at the payout ratio. So payout ratio refers to the percentage of net income a company pays out in dividends to common shareholders. So how much money are they giving back to shareholders? Or what percentage of money gained are they giving back to shareholders, right? Companies with low payout ratios like growth stocks choose to reinvest their net income into the company and other projects. So reason why growth stocks, right, would have lower payout ratios is because they're newer. It's because they haven't reached their full potential. So all the money that they're making, they're trying to put back into the company so the company can grow. And once that company has grown over a certain point, then they can start, kicking some back to the investors. And you can find payout ratio on the same page, just on a different side, right? So the payout ratio, damn, this is pretty high. For HD is 43%. So they're reinvesting 43%, right, of their net income back into the shareholders, which is extremely high. But beautiful, right? It's a good thing. They're putting money back into the people who invest into them. So you want to be in companies that's putting money back into their investors. That's a good sign. Next thing, we have assets versus liabilities, right? It makes sense to invest in companies that are making more money than putting more money out into the world, losing money, right? I want to know if this company making money or if they losing money, right? And you can find the information, again, just the same. Scroll to the top, go to financials, I believe, financials. Click total revenue, operating expenses. I know it's in here. Let's check, I want to say, it's either statistics, financials, or analysis. No, that's not this. Man, I'm sleeping right now. Did they take it out of here? Had to. Oh, I'm tripping. Balance sheet. I'm so tripping. It's in balance sheet. So total assets to date, 70 million in assets. Crazy. Total liabilities, 67 million. So that kind of worries me a little bit because they're right at about break even as far as assets and liabilities. Usually I want a company to have way more assets than they do liabilities, because then they'll be putting out less money. They'll be spending less money and they'll be making more. And like I said, you're going to compare this to other stocks in similar industries to find out what's good and what's bad for you. But I can tell you right now, I don't like that. That kind of bothers me. The 70 to 67 on HD kind of bothers me a little bit. All right. Next, we're going over dividend history. So dividend history explains the company's dividend payments in the past. Always look for consistency and percentage increase. So what that means is, right, certain companies pay dividends. Basically, they pay you back for owning shares in that company. What you want to look for, have dividends increase consistently? Have they decreased consistently? Have they always made their dividend payments on time? Have they ever stopped paying dividends? And if they stopped paying dividends, why? Why did they stop paying dividends? These are the things that I look for with dividend history, right? Because I want a company that consistently pays. If I'm going to own shares, specifically shares, I want a company that pays consistent dividends, whose dividend payments increase over time, right? And you can find that, again, Yahoo Finance, go to historical data, right here where it says show, click dividends only. And then for time period, you can go back as far as you want. So I'm just gonna click 5 years, and I'm gonna click apply. And boom, look at this. So let's just start with November 29th, 2017. The dividend payment was 89 cents. March 7th, dividend payment, $1. May, August, November, all $1.03. The next year, March 2019, it increased 36 cents. Did that until December 2019. March 2020, $1.50. Hold up now, HD is increasing its dividend consistently, and they're paying it out every 3 months, 3 to 4 months consistently, right? This is a good sign. This company is making some money. I'm getting a call right now, and I really don't know who that number is. I think I do. Cool. So yeah, always, if you want to invest in stocks for long terms because of their dividend, check their dividend history, right? Find out if they've consistently paid dividends, have dividends increased. Because then you're gonna make more money for putting, more money into those stocks. Next, we have the CEO. And you can find this on Yahoo Finance, but I prefer not to. I prefer Twitter. I say this all the time. I love Twitter. I Google who's the CEO of Apple, who's the CEO of Tesla, who's the CEO of HD, who's the CEO of Nike. And then I go follow their butts on Twitter, find out what they're talking about, because Twitter is like an information. People use it for their feelings, which is bullcone, but companies use it to disclose information and news about the companies. And I love it. I love it. And CEOs are, they get kind of personable on there. So the CEO, who runs the company? What are they investing in? What do they say about the future of their own company? What do they own shares of their company, right? Are they involved in their company? Are board members happy, right? Are shareholders happy? Do people like having this CEO run this business? Does the CEO have a good outlook for this business? What are the CEO's plans for this business? This is why I use Twitter, because frequently, a lot of these questions can be answered just by going through their Twitter and paying attention to what they're talking about, right? So I love Twitter. I love Twitter specifically for news with these companies, right? Always look at these CEOs and what they're talking about, and to make you a better trader. And that covers, a little bit of the basics, right? How is this going to help you? It's going to help you in 4 ways, right? It's going to help you predict price movement, right? Estimate whether a stock's price will fall or will it rise. If you know what this company is doing, you know how this company is giving back, you know what this company plans to do, right? You can be ahead of the curve in these trades, right? You can determine fair value just by looking at the numbers and comparing them to other stocks. You're going to know which one is a better investment, right? Because you know what they're doing. Analyze financial strength. If the company is not making money, if they have more liabilities than they have assets, why are you investing in it? If the company is losing money per share every quarter, every year, why are you investing in that company, right? You're going to know whether these stocks are strong financially, right? How much money do they have on the side? You're going to know whether these stocks are strong financially or they're not. And you're going to have the ability to beat the competitor. Institutional traders, they're your competitors. They're trying to take your money. If you know what's going on with these companies, like the back of your hand, you're going to be able to beat these guys, right? And that's the point, to make money. right? And you can do that. You can do that, right, in this market. So again, key takeaways. These we discussed. We discussed what is a stock, where stocks are traded, 4 ways to trade stocks, types of orders. We went over common stock terms, and we went over a little bit of fundamental analysis, right? And I just want to say congratulations, guys. Y'all understand a little bit more about stocks. Y'all know now where to do a little bit more research about stocks. And you just became a better trader. You just became a better trader. Congratulations to y'all, man. That's what's up. I'm extremely proud of y'all right now. It took me forever to learn this stuff, for real. And it took me forever to be able to do this on a regular basis and get comfortable doing it. So even after the stock market closes, I'm back to looking at a lot of this information for these companies, right? Because I want to make it repetition. I want to be able to do this as easy as I can snap my fingers. Because it's gonna make me a better trader. I know it will. So that completes our training. Again, I hope you guys learned a lot, and I can't wait to see how you all develop and get better as traders from this information, right? Don't forget the next time we're gonna meet up for the fundamentals is December 5th, and we're gonna go over technical analysis. So basically, we're gonna go over how to read a chart, right? Ways to read a chart, and you're definitely gonna be better traders after that one. For real, you're definitely gonna be better traders after that one. I think, matter of fact, I am. I'm gonna go in and update a little bit of some of them things and technical analysis because I can include the strat. Well, you know what? I'll make the strat a different training. But that's all for today. I hope you guys learned a little bit, and I can't wait to see you all December 5th. When you come back December 5th, come back with somebody. Bring somebody.
Yeah,
What's up? What's up?
I wanted to know if them types of orders that you were talking about is that on the Robinhood platform?
Yes, it is. Each one of those examples that I put on there, that was an example of completing those orders.
Like
So let's go check it out.
stop losses and stuff like that. I ain't know how to access it on there.
All of it's in there, right? So this is an example of a market order. You would click trade, you click buy, you click the number of shares, you click review, swipe up, market order. It's gonna buy right now, right? This is a limit order example. You click buy, number of shares, you click limit order. Robinhood gives you an explanation, tells you how this is going to carry out, right? And then you will click continue. You set your price of where you want to sell that stock or buy that stock, right? Whatever price you think is going to reach, and you click continue. Done. So when you go in and you're trying to complete these orders, Robinhood will tell you exactly what each one does, right? Mine is still on. You can't turn them off, but I leave mine on because I don't mind being reminded before I make those moves.
Got you, because I own something in Robinhood. I was just trying to see how I would be able to set those up.
Easy. So yeah, just follow along with the prompt here. So this is a limit order. Did I go back? I went to the wrong one. We just did limit order. So stop loss order. Go to buy. Go down to stop loss order. It tells you exactly what's going to happen. You set your price. Basically, trigger a market buy order when Walmart rises to. You put in your stop loss order. Basically, buy it once it reaches this price. Right. Boom. Good to go. Except most of these things Robinhood tells you, which is, like I said, why I love it, because it's getting more integrated, right? It's in telling us what's gonna happen or how things happen.
Winston, I'm not sure if you went over this in like the second session, but I think and I'm asking to clarify. My bad, that was my dog.
Are you good?
We can build our investment money like before we actually invest, right? Like we can essentially start like, you know, deposit $100, deposit $20, deposit $50 into our investment account before we actually start making purchases.
Absolutely. And never even trade. Just build up your account into an amount that you're comfortable with. Hold on one second, my guy.
Mhm.
What am I doing? Hold on. But yeah, you can definitely build up your account to, you don't have to trade until you're comfortable. You can build up your account until a number that makes you comfortable. You know what I mean? So treat it like a savings account. Put $20 in there every time you get a chance. Put $10 in there until and when you get a chance. You know, you don't have to trade just because you're putting money into your account.
Maybe I'm slow. Maybe I'm slow or something, but I'm saying like I own something already on the Robinhood platform, and I'm trying to see how I would be able to apply those types of orders on what I already own.
Okay, so like with so since you own it already, you're going to be on the sales side of all of these orders. So let's say you want to put in a stop loss order, you would go back to open up that position. You would click sell, and then you would look for stop loss order, right? And you're gonna put in the price you want to sell that stock if it falls or rises to a certain price. Same with stop loss limit order and limit.
Okay.
So yeah, if you're already in, so what you want to do is stop from losing money. So you need a stop loss. You know what I mean?
Right. All right.
Any other questions? Anything else anybody wants to ask? While y'all still got me, I got about 5 more minutes before I gotta dip. You can definitely ask in the chat if you're not comfortable with speaking. Shoot.
Hey, are you into cryptos as well?
I'm diving more and more into crypto now because I want to get more fluent at it, get better. But my issue with crypto is the fact that it's not consistent, bro. Let me stop recording.
I feel the same way.